Alright, let's continue to talk about another common AMT triggers. It's called private activity bounds, PABs. So what's the meaning of private activity bounds? So most of the time it's like municipal bound. So for example, there is local airports that need some expansion. So they will issue bonds called PABs to finance that certain operation, certain expansion, something like that. And say you own certain companies or that you invest in these PABs directly, and then you got for example, it's a bond. Let me just give you some exact number here, right? So for example, you invest in $1 million of the PABs, and you got the rate, say 5%. Okay, so basically it's an annual interest rate. So that means per year you're going to get 50,000 US dollars of interest income. Okay, this is interest income, and under the regular federal tax system, you know what? This is like a municipal bond, and most of the municipal bond is, including the PABs, is tax exempt. Okay, so basically you don't need to pay the tax. But as I said, there is a difference between the AMT system as well as the regular federal tax system. Okay, so under the regular form, for example, if you are a US taxpayer, so there is a form called 1040. Okay, so basically you are going to put your form 1040, and you got all this taxable income filled in. Do you need to add this 50,000 US dollars of municipal bonds interest? You know what? You don't need, right? So, well, you think that's great. It's like a free income without tax, right? But as I said, this is the regular federal tax system. But under the AMT rules, that there's a different treatment. So basically, on the AMT rule, the interest from the private activity bonds, the PABs, is added back into the alternative minimum taxable income. So as I said multiple times, this is called AMTI. Okay, so you're going to add it back. Okay, let me just give you some numbers so it makes real for you. Okay, so you can get the gist of how to treat it under the AMT rule. So, for example, if you got the regular taxable income, say you got 300,000 US dollars of a regular taxable income, okay, and you also got the regular tax liability, say 52,000 US dollars, okay. So right now, you calculate the AMTI. You're going to get the 300,000 US dollars, and you're going to get back this 50,000 US dollars. Remember, that's per year's interest, right? This is PAB's interest. I'm going to use INT for interest. You add this back. So the AMTI will be 350,000 US dollars. Okay? And of course, this is not the whole amount that you are going to calculate for tax. There is a specific AMT exempt. So, exemption. Okay? AMT exemptions. So basically, you are going to really look at, and you're going to check, because as I'm recording these videos, the IRS constantly updates the exemption amount, right? So the amount really depends on the law of that year. I want to make this video evergreen in the time. So I'm not going to just give you the exact exempt amount, right? And so basically, you're going to subtract the exempt, right? So you got certain exempt amounts. So for example, I'm going to using an X here. you're going to subtract this x. Then you're going to get this y number. Okay? And then that is the amount that you're going to apply the AMT rate. So a certain AMT rate, normally is 26% or 28% to that result, and that will be the amount of tax under the AMT rules. So, for example, the normal tax will give you a liability. This is the regular tax. Regular tax. Liabilities is 52,000 US dollars, and we got y multiplied by AMT percentage, right? And then you're going to compare this. So, for example, this result will be Z, and then you can compare this with Z, right? Regular tax and Z. So, if the AMT calculation Z is higher than the regular tax, so the taxpayer must pay a higher amount. That's the that amount. Okay? So, yeah. And of course, as I said previously, for example, if it's about depreciation, that's the timing items. Okay? So basically, you got the tax liability, and then you're going to get it back as a tax credit. But here is a little bit different. Okay? This add back is permanent, right? Remember, we add this PAB interest back. Okay, so basically this add back. I'm gonna add a little bit extra here. This 50,000 US dollars of tax add back all the way to calculate the AMTI is permanent. And say, hey, I already paid this AMT, on the PAB interest, right? I pay this. I pay more tax. Should I get a credit in the future? No, this does not generate an AMT credits, so you can't use these tax credits later. Okay, so this is not timing items like depreciation. Okay, this is not like right now and future difference, but rather this is just another tax that you're going to pay if you fall into the AMT rule. Okay.